Today should have been a promising day for stocks. We started the day off with GDP numbers in excess of 4%. We saw Amazon come out last night and just crush their earnings estimates. But by the end of today's trading session, we saw a turn. We did see the small caps really struggling again, and we saw the tech stocks struggling again. In particular, Twitter was down 20% today. Of course, this is one day after their social networking competitor Facebook was down 19%. So some struggling going on in some of those high growth areas. We'll review that. We'll also talk about an area that did hold up today in the consumer staples space for our trade application. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's July 27th, 2018. For those of you that are new, first of all, welcome aboard. We're grateful to have you in our audience tonight. Remember, you can subscribe to our YouTube channel, and while you're there, check out our description area where you can sign up for our email distribution list that'll entitle you to not only being notified whenever we release these videos on a daily basis, but also give you a heads up on what stocks are giving you overbought and oversold cluster signals within the S&P 500. In addition to YouTube, we're also heavy users of Twitter. If you're not doing so already, make sure you're following me at Brandon Van Zee. And make sure that you're liking and retweeting these Market Outlook related videos as well if you want to let David and I know that you appreciate them and want us to continue them going forward. In addition to Twitter, we're also on Facebook. You can see the group web address in the logo in front of you. All right, with that, let's go ahead and do some analysis on the markets here. You can see that I've got the 4 grid pulled up here of our 4 major U.S. market indices here. This is chart 4B for those of you that are premium market scholars that want to follow along with this presentation. And what we're looking at here is basically a way to take a look at the 4 different indices in the United States and judge them in terms of their intermediate term posture. Remember, that's what we're using mostly when we're using this market forecast indicator tool that's pulled up at the bottom of each of the price charts. What we're looking at when we're determining that posture, again, is that intermediate term line. That's the green line that you see down below here. And one quick way for your eye visually to determine whether we have a bullish or bearish posture on any of these indices, just look at the chart itself, because that'll tell you what you need to know. What I'm referencing in this particular case is the background color of the chart. Notice that it's green in the case of the S&P 500 in the upper left. It's green currently for the Dow Jones in the upper right. It's green currently for the NASDAQ composite in the lower left. But look at over here where we've got that pink background for the Russell 2000. So this is something that we've been kind of dealing with for the last few days, where we've seen that Russell 2000 kind of turn into a laggard. Remember, we typically want the Russell 2000 to be more of a leader. It can be a little bit more of a risk-on signal when the Russell and the small caps are leading the ways. But that's just not the environment that we're in right now. So we continue to have that bearish posture there. Not only that, but we're at risk of potentially losing the bullish posture for the NASDAQ as well. Notice that the NASDAQ had a really ugly candle here today. We were down 1.46% on the NASDAQ. Now that's in comparison to the S&P 500 where we were down 0.66%, the Dow Jones only down 0.3%, and then the Russell was down even worse than the NASDAQ, down 1.89%. So clearly those bottom two were the areas of concern for the market today. And again, those are the more speculative areas in terms of these 4 major indices right here. So it's not necessarily a great sign. As it stands right now, we do retain that bullish posture on the NASDAQ, but remember, once that green line falls below 80, that would be then a bearish posture. So we're at 84 and falling right now. We're starting to have some jeopardy when it comes to the retaining of that bullish posture. Remember, we've had a bullish posture for basically the whole month of July, so we're probably due for a little bit of a give back period here for stocks, but this did happen in a hurry. In fact, as most of you are aware, what the storyline behind the market here recently has been the growth stocks. In particular, FANG has the market's attention. In fact, on Twitter here just a moment ago, I did post something that might be interesting to some of you. Let me pull it up here. So here's my Twitter feed. Again, make sure you're following me. It's just at Brandon Van Zee if you want to stay up to date with my market thoughts throughout the day. But this was just a quick tweet that I put out that said, Despite Amazon's big earnings beat, today was actually an uglier candle for the combined FANG than any day in the last 3 months, including Facebook's big down day yesterday. So if I click on that particular graph that I tweeted out, this is basically a way that you can build a graph with multiple ticker symbols equal weighted. And so you can see up here with this left kind of blue arrow, says Facebook, Amazon, Netflix, Google. You can basically just, on the Thinkorswim platform, put a plus sign between all of those to pull that up as an entire group. And what I was referencing is today's candle looks really ugly. Obviously a bearish engulfing candle from yesterday, but it was a day that should have been promising when we started up near the top with Amazon having a blowout number, but by the end of the day, everything just kind of fell upon itself. So that is a bit of a concern. In addition to that, we have a concern with the VIX that we'll talk about here in a little bit as well. The VIX rose, and we're just seeing, generally speaking, more interest in the value-oriented names and the growth-oriented names here near the end of this week. Now that we're over here on the internet, I might as well identify a couple of other things here as well. Wanted to discuss what I mentioned in the intro, which is the GDP number. This comes from Econoday here. Remember, they have an excellent economic calendar over there. Of course, today's big number was that GDP number. It's going to be one of the most influential numbers from an economic perspective in terms of its reaction in the stock market in most cases. So we actually did have a good number that came out. Here is some more data on that from Econoday, and you can see that it again came out. The GDP number came in over 4% here, 4.1 to be exact. So that was a very strong number. A lot of folks were saying that was the strongest number in several years. To put that in perspective, normally we would have been happy with a 3% print. So this was a huge number here. And when President Trump was on CNBC this morning, it made it seem like this is something that we should get used to in coming quarters as well. Now we'll see if that happens or not. You know, one of the drawbacks of the number is what Econoday mentions right here. Net exports were the next biggest contributor, adding 1.1 points. Well, it's not that net exports coming in strong is a bad thing necessarily, but in the context of our situation today, a lot of economists feel that what could have juiced this number up to 4% this quarter was all of the exports that were getting in before these potential tariffs kick in for these foreign countries, and kind of front loading that number to a degree. So I think that kind of soured the market to a degree once they started to absorb some of that additional information that came with it. But certainly on the whole, you know, a 4% print on the GDP is an outstanding number right there. The other thing that I mentioned, since we're over here on the internet, for those of you that watch this video on our website, remember it's just marketscholars.com. You can click on blog up here at the top. Remember, we make it nice and easy for you to come down below where you're watching the video and kind of engage with the content. So we have our Twitter feed off to the left here typically. We have our Facebook feed off to the right, and then we have one other thing that you can click on down here to like it on our website. So I appreciate the 90 of you that liked it on Twitter yesterday, all of you that did it on Facebook as well, and then you 54 that did it on our website as well. That again just sends the message to David and I that this information is useful to you and you want us to continue to do that. So if you guys could kind of make that a habit, that would be fantastic as well. As you can see, we've got some upcoming classes as always. Next week I will be teaching my top-down trend trading class on Monday at noon. We actually got stopped out of a stock today, so I'll be bringing that up with my class on Monday to see if we can find a healthy replacement for that. So if you are a premium member at Market Scholars, make sure you're joining me for that. And then I'll be teaching an options for long-term investors class Monday night. Then, of course, dividend growth investing Tuesday morning. So a lot of good content coming your way there as well. Let's go ahead and get back on over to the charts now. Let's take a peek at the markets here from a slightly different perspective now. Let's go over to a long-term view using the 1040 crossover method. This is going to be chart 4D for those of you that are following along at home. And since this is Friday, remember David normally does the Friday video here, but since he's on vacation enjoying himself right now, I am in the driver's seat, and so I thought it would be a good idea to review the charts here, because remember this particular chart is somewhat unique in that we're using weekly candles for this. So, you know, we do bring it up on occasion throughout the middle of the week, but it's really not until Friday's close today where the candles are kind of locked into place. And so as you can see right here, We don't have any concerns from a posture changing perspective. For those of you that are new to looking at this, basically it's a 1040 crossover method that we're using here, and we're using exponential moving averages. We're applying that to a weekly candle chart. Each one of these charts goes back over 3 years in time. And so what you're looking at here is how this orange line, which represents the 10-period exponential moving average, has a relationship with the blue line, which is the 40-period exponential moving average. As long as the orange line is above it, that suggests that we have a relatively bullish market environment that we're in. And that, of course, is the case for all 4 of our major indices here in the United States. You can see that the background color of the chart will switch from pink to green whenever we go from bearish to bullish, when we do see that particular crossover occur. And then once we flip back to the other side, you'll see it go from green to pink. But that's the good news that we're in right now. Had you just had your slow money that maybe you park in your 401k or mutual funds or index funds or what have you, just going into the market when we had this crossover over 2 years ago, you're probably fairly happy about that. Now, obviously, there's always better returns somewhere else, but of course, there's always worse returns as well. So depending on how active you want to be in the markets, this can be an effective tool if you're trying to capture that juicy part of the trend in the middle. Now, the tricky part, of course, is not all trends will last for multiple years like we've seen here, but fortunately in this case, that is what has happened here. So this posture remains on track. We continue to be bullish. We very well may have some choppy, shorter term activity here in the summer and leading into the fall, but right now we're still on track to retain that long-term bullish posture from everything that we see on the charts. Let's now do a little bit of diving into our 12 grid analysis, starting with the intermarket analysis. And so as that pulls up, just a reminder that when we're looking at these charts, if you see a green background color, it means that that particular security has a bullish posture from an intermediate term perspective, according to the market forecast indicator. If you see a pink background, it means it's bearish. So where we stand right now with most of these on the board in front of us is more of a bearish posture. Now, if you're looking at the VIX, take a look at that big move we had out of the VIX. It was up about 7% today, but actually when I was looking at it earlier in the day, it was making a more aggressive move. So you can kind of see that both ways. Yes, fear did come back into the system a little bit more so than what we saw yesterday. Yesterday was very peculiar to have Facebook getting clobbered as badly as it did and having the VIX down. Today was a little bit more normal, that relationship that you would anticipate, where stocks struggled and the VIX did go up. Remember, it wasn't just Twitter that struggled today. There were others like Intel, big time players that really struggled here today. So you are starting to sense that fear is coming back into the market just a little bit more. You know, I think most of us would agree 13 is still awfully low in the VIX, but it's a bit higher than it was yesterday. So maybe a few more people fearing a little bit of a summer slowdown here. In terms of other charts here to identify of importance, you know, a big part of our focus here recently has been on that US dollar, and that's your chart in the lower left-hand corner here. Notice that it does have a bearish posture right now because its intermediate term line is at 56 and falling, but if you look at price action, it's still above a rising moving average. So I don't think the story's been fully told on this yet. It's entirely possible that the dollar kind of gets out of its shorter term funk and gets back into its kind of longer term rise that we've seen over the last several months. Now remember, when the dollar is strong, it can affect the commodities in a negative way. You will notice that gold was down 0.23% today. You'll notice that ag was down 0.46% today. And you'll see that crude oil was down 0.82% today. So kind of weird that we had the dollar down just a little bit, although maintaining its trend. But then we also saw the commodities all down today. Now notice that crude oil retains its bullish posture. Its intermediate term line is at 46 and rising, but I'm not sure how excited I am about this price action here on the candlesticks. Notice that we had kind of this big meltdown move in crude oil. We had this nice reversion to the mean right back up to that moving average, but this candle right now is kind of giving us the impression that it's a bit of a hanging man type of a candle. Remember, anytime you want to zoom in on any of these 12 grids, and by the way, this is chart 4E for those of you that are following along at home. If you want to zoom in, remember you can just right click on any one of the charts and go to maximize sell. You can kind of see that a little bit better. It's not a picture perfect hanging man because there is a little bit of a small upper shadow up there, but it does give you that impression that you're at a bit of a resistance area on the underside of that moving average, and therefore could present some problems there as well. So we'll see where that takes us next week. Just be on the lookout for it. You will notice that with crude oil being down, it really did impact the master limited partnerships pretty dramatically here today. Notice that the MLPs were down over 2% today. I was just singing its praises yesterday, saying how nice the last 2 days worth of candles were, and it just turned around and failed on us just like that. Now, of course, the posture is still bullish, so we don't want to make too much of it. We still have that green background color, and we're still above a rising moving average, but it would have been nice to see if they could have retained that strength that they had going into last night's close, and unfortunately, they gave back all of yesterday's gains and even cut in to Wednesday's gains to a large degree as well. Let's take a look at some other 12 grids here. Let's now focus a little bit on the foreign stock markets. And as you can see, it's a bit more of a mixed bag here. We've got kind of a few of the bearish ones down here near the bottom. We've got the United Kingdom, Israel, and Australia as our bearish posture charts from an equity perspective in the foreign markets. The Israel one is a little bit surprising to me. I was impressed with the way that it was trying to break out yesterday. I did say that, you know, we had a nice breakout. Unfortunately, we did close near the lows of the candle, so it wasn't a beautiful breakout, but at least it attempted it. Well, today it looks like traders weren't overly impressed with Israel, sending Israel down 1.4%. We're still above that rising moving average, so I don't think the trend is wrecked yet, but clearly more flies in the ointment today after additional information. Some of the areas that did stand out here today, notice that India had a nice day. India was up about 1% here today, EPI, and notice that it was a nice clean break above this prior resistance area that had really been established going back here since the middle of June. And not only that, but we closed near the high of the session on EPI, which I think is a strong statement as well. Remember, this was a very difficult close for most stocks, especially here in the United States. So to see India's stock market kind of close near the highs, I think does lend it to maybe a little bit stronger bullish support right there. So keep your eye on India going forward as well. Let's take a peek now at our U.S. markets through the lens of the sector breakdown. And as you can see here, we only have a handful of so-called bearish posture charts on the board. We have discretionary in the upper right-hand corner. That was a pretty ugly looking candle there as well, but remember, discretionary was dominated probably by one big name today, and that name is Amazon. Remember, a lot of times people think in their head that Amazon is a tech stock. That very well may be the case for some of you, but from an official perspective, from a global industry classification system perspective, or GICS, you will find that Amazon is actually part of the discretionary sector. And so when you look at that candle, it is reminiscent of how you would look at Amazon. In fact, let me right click, go to maximize sell. Here's XLY, and now let me show you Amazon if I were to type that in, AMZN. Notice that really ugly looking candle today where we started high, ended low type of price action right there. So anyway, that's why the XLY looks as it does, but it's still above that moving average. Down below we have telecom that continues to struggle. It just can't get out of its own way, it seems. But then we also have real estate down below here that took a bit of a tumble here as well, but it is kind of hanging out at that elevated moving average. So we'll see that where that takes us. But otherwise, you know, it was a difficult day for the market, as I mentioned before. However, there were a couple of areas that did stand out that remained in the plus column. Notice Staples down here. Staples making a nice move. Take a look at that. You know, I wrote a column earlier this week on See It Market about Hershey's, and we'll talk about that here in a little bit as well. But one of the things I mentioned in there is that from a year-to-date basis, the staples were still the worst performing sector. Now, most of you are aware, because you've been attending these presentations for quite some time, that the staples have actually been one of the strongest sectors in the last month or two. So it's kind of a weird situation where they're still down tremendously since December 31st, but they're up and they've really had a nice bounce in the last couple of months. So that continued today. Notice that staples were actually in the plus column today despite the markets really struggling. Staples were up 0.13%. You also found that the financials, which haven't been talked about quite as much here recently, but the financials were up 0.21%. Now remember, part of that is likely because of what's going on with interest rates. You have seen a nice pop higher with TNX right here in the last week or so. So that's helping to support a lot of those banks and brokers and what have you there. So don't forget about them. They've had a nice recovery since having this oversold cluster signal right down here, basically calling the bottom right around June 27th or so is when they got that oversold cluster signal. Had a nice reversion to the mean since then. Now where we stand with it, of course, is up here at a resistance area, so be careful with that. But at least they didn't break down today when they could have had every right to do so because the markets themselves struggled so much. Let's take a look at a few other charts before we get into our trade application example. Let's take a peek this time at our ratio charts. Now this is going to be 4i for those of you that are premium scholars. And there was some interesting price action going on here today. You know, the market has really been defined by its need for growth. At least that's kind of how most people have thought about the market in recent years. And along the way, we've found people obsessed with FANG and obsessed with the idea of going into those hyper active growth types of companies out there. And in the meantime, a lot of value stocks have gone nowhere. And so one of the things that you can do with this chart set here for I is look in the lower left-hand corner. You've got a ratio chart here that says growth stocks divided by value stocks. And how you can read this chart is the direction of the chart will tell you which of those two things is outperforming the other. So if the chart is going up, that means growth stocks are outperforming value stocks. And look what's been happening here in the last 3 months. That's largely been the case. Now, of course, there's always these momentary times where the chart goes down a little bit here. But for the most part, this is a chart that starts in the lower left and ends in the upper right, except for the last 2 days. And of course, part of the reason for that is what's going on in the world of technology, right? With Facebook and with Twitter and Intel and a lot of these tech companies that are really starting to struggle. You might start to see a little bit of a handoff in investors' eyes from those really strong growth names to more of those value-oriented names that are out there. So that one I thought was quite interesting. You're also finding directly next to it here in the pink, discretionary versus staples. That can tell us a lot about markets as well. And notice that for this 3-month chart right here, the first part of the 3-month chart, it was discretionary clearly beating the staples. But about in the middle of June, there was that handoff that took place where all of a sudden the staples started outperforming the discretionary stocks. And that's why this chart started going down. And today, of course, was very representative of that as well. In fact, where the ratio lies at this current moment is taking the chart all the way back over here to May 3rd. So we are now in a market that is being controlled more by the staples than by the discretionary stocks. And remember, that's not necessarily a bullish sign for the overall markets. I myself enjoy it, don't get me wrong, because of my interest in dividend growth investing, but I also recognize that for the health of the overall market, it would actually be better for the discretionary stocks to be outperforming. So that's another bit of a sign that perhaps there's a slowdown that's upon us. Perhaps there's a little bit of a risk off that's taking place. Next to that one over here, we have the equal weight S&P 500 divided by the market cap weight of the S&P 500. And notice that that had largely been a falling chart up until the last couple of days. And in the last 3 or 4 days or so, we have seen a bounce off of those lows. And so what that is kind of telling us is that that FANG name is, or that FANG idea is being thrown to the sidelines a little bit. Because remember, right now, if you look at the market cap weighted S&P 500, it's basically tech dominated, right? It's your big kahunas out there. It's your Googles and your Microsofts and Facebooks and what have you. And so that had been an okay place to be here recently. But of course, in the last 2 days, we've seen so many destructive earnings announcements that has kind of reversed course. And now all of a sudden, you're almost getting a weird situation where breadth on a relative basis is actually getting better simply because the biggest mega cap stocks have gotten clobbered so badly in the last couple of days. And then lastly, over here to the right hand side, you do see the small caps versus the mega caps. And of course, this kind of looks somewhat similar to the discretionary versus staples in that it's a tale of two cities on this chart. In the first half of the chart, small caps were just ripping higher compared to the mega caps. But starting right around here, about the last week or so of June, we've had a reversal of fortunes where the mega cap stocks have now been clearly leading on top of the small caps. And again, that's not necessarily a great sign. We want the risk on environment would actually prefer the small caps to be doing better. They would prefer the discretionary stocks to be doing better, and they'd prefer the growth stocks to be doing better. And that's largely what we've had earlier in the year. So I'm pointing this out to let you know that there are starting to become, some areas of the market that we are getting a little bit more concerned about. I mean, this is not a bear market, don't get me wrong. It could turn into one at any given moment, right? But right now we're not in any jeopardy of that. I'm just merely pointing out a few of those areas of weakness so that way we can keep our eye on them and see where it leads us going forward. So in the spirit of all of that information, let's now talk about our trade application example for the day. And so let me pop on back over here to chart 4A so we can just have a regular one grid. And let me go over to the internet here just briefly again. I wanted to kind of show you, oh, by the way, I'm going to have my new sector selector coming out this weekend, so be on the lookout for that as well. But what I wanted to show you here was this article that I wrote for See It Market earlier this week. I've mentioned that in the last couple of Market Outlook videos as well, so if you haven't read that yet, make sure you go over to See It Market. It's a fantastic organization, and we welcome in all of its viewers as well, so thanks for joining me here tonight. But anyway, go back to the article I wrote on July 25th called Hershey Stock Trick or Treat and read that to get an understanding of how I think about dividend stock analysis and how we can kind of get into this predictable nature of understanding when a stock is going to raise its dividend and by how much, and how that could potentially impact the stock depending on where its yield is from a historical perspective. So make sure you check that out. Appreciate all of you guys that have already said a lot of kind words about that. Of course, when we were looking at this stock earlier in the week, this is Hershey's, HSY is a ticker symbol. We were attracted to it right here when it was a $92 stock. Now, I had expected a dividend increase to come out on Thursday morning, and that's exactly when it did come out, and it came in at the top end of my range, and the stock responded very, very positively to it. That stock was up like 7% yesterday, so a great move higher. For those of us that have been selling puts like we have in my various classes at Market Scholars on Hershey's in the last couple of months, that was a favorable development there. We did finally get a bottoming started here in Hershey stock. You can see it's been a very ugly looking chart up until the last couple of weeks and months here. So this bottom, I think, is helped and being supported by income investors. As I mentioned in the article, the last time we truly had a 3% yield on Hershey's was way back here where this black arrow is, and that was in early 2010. So it's literally been 8 years since Hershey's has had a 3% yield, and I think that is a level where this very high quality company will become very attractive to income investors. Well, since yesterday's big move higher in the stock, that of course moves us away from where we might want to buy it for the long term. Remember, we always want to buy a high quality stock when it's cheap, not when it's expensive. But this is a very unique situation. First of all, the stock did fall today. So let me pull up Hershey's stock now, kind of zooming in on the more recent time period. So here is Hershey stock, and you'll notice this was the big candle I mentioned yesterday where it would just shot up like a rocket ship off of its dividend and earnings news there. Well, today you can see it gave back a sizable portion of that along with the rest of the market. It is now trading just a hair below $97. Well, that is going to be awfully close to where that 3% level will be on the new dividend rate going forward. Remember, Hershey's, when they came out, they reported their quarterly dividends, and their quarterly dividend amount that they raised it to was 0.722. So up here on the Thinkorswim platform, it's still showing the old amount of 0.656, and so that yield of 2.7 is not accurate at this moment in time. That yield should actually be higher than that. In fact, let's calculate it here together. Get my calculator out. Take the new rate that they just announced yesterday, 0.722, take it times 4 to annualize that number to 2.888, and then divide that by the current price of the stock, which is $96.99. And you'll notice that its current yield is actually 2.977. So it's knocking on the door of a 3% yield. It's not quite there, but it's knocking on the door of being there after today's pullback in price. Now, when you look at today's pullback in price, you'll notice that we still have a bullish posture according to the market forecast. That's why we have that green background color right there. And you can see that we almost put in what's known as a bullish intermediate confirmation signal today as well. Remember, that occurs when you have the green line that's bullish, which it is right now, combined with the red line in the lower reversal zone below 20. Well, it's basically sitting on the lower reversal zone right now. It's at 20.05. So it's literally as close as you can possibly get to a bullish intermediate confirmation signal as you can imagine. So for all intents and purposes, it's basically that buy the dips mentality. Well, as we come over here and we take a look at chart 3A, which is that dividend stair-step chart that I referenced before for the article as well, and we pull up ticker symbol HSY for Hershey's, you'll notice that that dividend stair-step chart has now started jutting higher here to account for the new 72-cent dividend rate that it'll have going forward. And so where we stand right now with price, you can see it's awfully close to that blue plateau there that would represent that 3% level, again, for the very first time since going way back here to 2010. So when we're in a situation like that where we're very close to a level where we might want to buy a stock, but we're not quite there, then what that opens us up to is the idea of selling a naked put. And so I've got HSY pulled up here on the trade tab of Thinkorswim. I've got our options contracts pulled up here in the middle, and I'm going to concentrate my efforts on the right-hand side where we have the puts. Now, for those of you that are not familiar with this strategy, selling puts is kind of a two-pronged approach. You know, some folks will look at it as being a successful trade if they sell a put and it expires worthless and allows them to kind of keep all that credit that they received up front. If that were to occur, it basically means that the stock does not go down below the strike price. Other folks may actually sell the put in the hopes of attaining a high-quality stock at a lower price. I personally do view Hershey's as a high-quality stock. Others may disagree, and that's fine. There's room for disagreement in the marketplace. But the point being, what you think is a high-quality stock, you can sell puts on, and it's a way for you to basically capture that stock at a cheaper price if that stock keeps on going down. And so in this particular example, where I'm going to focus my efforts is at about the 1% return on risk area, which would lead us to the 95.5 strike put here in August monthly contracts. So these are just the normal monthly contracts here. Remember, Hershey's does trade weeklies, but I'm referring to the monthly ones with 21 days until expiration. So we can see that the 95.50 is now available for basically 1%. So what that means for us is, in this case, we can probably sell it for about 95 cents. Now remember, this is after hours on Friday, so who knows where the options market opens on Monday morning. But assuming we can get filled somewhere in the middle of the bid and the ask, let's say at 95 cents there, between 91 and $1. So if we get filled at 95 cents, what that's effectively saying is that we're willing to take ownership of Hershey's at $95.50. Well, it gets better than that because some folks will think about it in terms of the true break even being not $95.50, but subtracting out the credit that you're going to receive up front, in this case 95 cents, and your break even would actually be $94.55. Now that looks quite attractive compared to tonight's closing price on the stock of $96.99. And of course, that break-even price would then push us through to an actual 3% yield if we were to be put that stock at the end of the expiration period. If we wanted to kind of do that calculation real quick, again, we'd take the new dividend rate, 0.722, take that times 4 to annualize it to that 2.888, and then divide that by our break-even on that sold put trade of 94.55, and our new yield on cost would actually be 3.05%. And again, a 3% yield hasn't formally existed on this stock since 2010. So that's what we'll do for tonight's trade application. I'm going to come over here and just click on the bid price. We're going to change this amount to 95 cents to see if we can get filled at that price when the market opens up on Monday. So I'm going to click confirm and send, review that one last time. Again, we're taking in $95 to start this trade to say, hey, we're willing to buy this stock at $95.50 if the stock price continues to fall in the coming weeks. So I'll send that off and see how we do. All right, well, I want to thank you for joining me here tonight. It's been fun to get a little extra time with you this week with David out of the office. So I hope you enjoyed tonight's presentation along with all the rest of them. Remember, if you did, make sure you are liking and retweeting on Twitter, like us on Facebook, do all that fun stuff on social media to let us know. It is truly helpful, especially for a small business. Thank you to all of our new viewers as well, and we'll look forward to joining forces with you again next week. Have a great weekend, everybody. Take care.